well that if you want to watch this, I guess, on the actual webinar, then hi everyone, you should all be able to see and hear me loud and clear. Let me know where you're from. We've got the weekly stock market update and we are starting straight away. Sorry, I am a couple of minutes late getting into it, and hope 8:30 is okay as a time. I'll try and not move it around too much, but just lots going on basically. Hi from Cardiff, Chris from Aberdeen. We have got people from Newton Le Willows. That sounds posh. Barry from Pinner. Not so much. Cheshire, North London, Richmond down the road, Quebec, from Canada, we've got Scotland and Bedford. Now, let's kick off with the update. I think I've got about 200 slides to go through on the stock market. We've got some interesting developments, and let's have a look at where the money's going in and what we can do. Jeffrey, hello. Sorry it's late for you, Jeffrey. Derek as well. Good. Taunton as well. Now, okay, here's what's changed since Trump. Okay, you're seeing a lot more of this. Deutsche Bank sees S&P 500 rising to, I'm just going to move this. I've got I'm doing the live on TikTok at the same time, and you'll see why social media is so important to me in a second. So look at that. It's changed. It's going nuts now. That's not me saying it. That's Deutsche Bank. Targets S&P 500 at 7,000, the economy roars. Now, this is the Trump effect, okay, quite clearly. And those projections go to their wealthiest clients. Their wealthiest clients will act upon it accordingly. Before I get into the stock market, just let you know, as is my new thing, how the week's gone. So I just did I hosted a cybersecurity online conference. That's me. That's with my government hat. That's me at the Department for Business and Trade. As other of my government work all started when I had hair, and I was 29. You can see that over there. I really am called a deal maker for the government. So that's the cybersecurity hat. That was a good week. I try and feed into what I'm seeing in the private sector into what might be the case for public companies that I might want to have in my portfolio. Now, I'll give you an example. Palantir cybersecurity, bit expensive though. So we'll go into some of those things later. Then we had a meetup. That's Sunday, 9 a.m. Claridge's with some of my clients. That is the YouTube Silver Award that I got. And there's my gorgeous son over there, my beautiful wife and so on, meeting some of my Great Investments Program clients this past Sunday. I'm going to do some more at Claridge's for Great Investments Program people as well going forward. Just all let me know you can see and hear me loud and clear as well while we're at it, because sometimes I do these. Then about half an hour later, I realize, oh, actually, nobody could hear me. The past fortnight, as I mentioned last week, has been quite busy. I hosted that event. This didn't happen in the past fortnight. She got appointed in the United States. See if you know who it is and what appointment she got. That was an event I hosted at LinkedIn for scale-ups in technology. That's me there as well. So rocking it there. Okay. Now, as you know, the other new thing that I've started doing is what I call the profit playbook. It's my sort of market insider insights. It's where I take all the insights I've got out of my government roles, both on the UK side, the US side, from the hedge fund industry, the things that I'm seeing crossing my desk from the wealth management industry, and try and give you insights which you can't get elsewhere. Excuse me. Because, of course, after all, if you could get them elsewhere, then what's the point of getting them through me? Now, I'm going to post this. If you're on the Great Investments Program, you've already got this in a detailed version on the private Telegram channel. For everybody else, you'll get a version of it on TikTok and YouTube later tonight. Okay, so I'm not going to go through all of these. What I will be covering is why the Trump tariffs are not a bad thing for the US economy at all. In fact, they're rather good. Why Bitcoin will continue higher, partly because of an FCA announcement earlier this week. Also, why, from my visits to Beirut in the past, this time it really is different in the Middle East. And I'm going to explain that and why that's good for the markets, and why the assassination of a rabbi in the UAE proved what is possible in the Middle East in terms of peace, actually. Obviously, the assassination wasn't peaceful, but the reaction subsequently was that, and what that means for the market. So it's not a political peace, it's a what does all this mean for the markets? And that relates to the Abraham Accords, which came under Trump 1 when he won the first time as well. What I'm seeing in cyber, I'm going to explain, and why I think I sort of get what Trump is doing. When I was at university, I read both his book, Art of the Deal, and a whole bunch of economics books at the same time. And boy, has that paid off, because it's a lot easier to understand him now as a result. And I think the media is completely misreading what he's got planned. Of course, if they could understand it, they wouldn't be in the media, they'd be in politics. Now, that's all going to be on YouTube and TikTok tonight. If you're in the Great Investments program, you've already seen a version of it on the private Telegram channel. So I don't want to take up, because otherwise this live webinar will go on forever. Okay, now the approach I'm going to use, I know this is blurred because this is talking about the approach, not specifics. I'll come to specific stocks in a moment. The approach I'm going to take when I talk about stocks in this webinar is, as you know, and a recap to everybody who's new. And if you are new, just let me know, actually. Put it in the chat box that you are indeed new, and that'll be useful for me to know that you're new. I'm going to send a reminder to everyone live now as well, because there's a whole load of people on my public Telegram channel who might not realize that we're live. Now, excuse for the throat. What approach I'm going to take when I go through the various stocks, whether it's the stocks that have come out of the biggest wealth management banks like Goldman Sachs this past week, or out of the biggest, best performing hedge funds, or out of my own filters, is do they meet my value, growth, income rating? Now, many people try and reverse engineer things. This they can't. This is based on the academic research out of 3 Nobel Prize winning economists, Daniel Kahneman, Eugene Fama, and Richard Thaler. And what it does is it looks for undervalued companies which are growing with dividend yields. And I've based it on the research they found, not on just, oh, well, this is good and this is what a journalist says. I couldn't care less what journalists say. I couldn't care less what anybody says who isn't either a Nobel Prize winning person, or a Warren Buffett, or a Jim Simons, or basically managing billions. Okay, so either to qualify for me to pay any attention to you, I want you already to be managing billions, or I want you to have won the Nobel Prize in economics. Anything short of that, and I really don't care. So in a way, you could say, well, none of my stuff's original. It's all based on what those individuals have said. Yeah, exactly correct. So I've used that as a basis for determining that scoring. That helps me narrow down 10,000 securities into about 200. Croki comes from Goldman Sachs Wealth Management, who manage, I think, well over $1 trillion for clients, certainly have influence over 10 trillion. We want that to be, basically, I want everything to be green. If it's not green, it doesn't meet minimum criteria. Croki is important because it's cash return on capital invested. However, you'd be incorrect to put too much weight onto it, because it has to be combined with this. Otherwise, this alone will not be sufficient in our experience. Momentum comes from the hedge fund industry, Sortino and Alpha also from the hedge fund industry, more so the Sortino. Alpha sort of less so. It tends to be bandied about without people actually realizing what it means. It doesn't just mean outperformance of the market, but you've got to look at which market over what time frame. More importantly is the Sortino. But of all of these, if I had to pick one which is incredibly important, it'd be value, growth, income. So I'm going to put all the stocks that I talk about today through those filters. And there's no harm in filtering even more, rather than just saying, oh, here's a good story. We are data driven. We are not story or narrative driven. We are data driven. Okay, so I'm going to go through that. This, for instance, is one of my clients, and he put together a portfolio like this. Pretty straightforward and simple portfolio, which was suitable to him. Now, here's a very important point. First of all, just because it's suitable to him and his family doesn't mean it's suitable for you. Secondly, it is actually incredibly simple and straightforward. They're names you've heard of. So we don't always need to have the most esoteric names nobody's heard of. What he's done, which is good and suitable for him, not for everyone else, is he's got quite large allocations in a few, which I don't mind because it was suitable for him. He's done some leverage, which was suitable for him. Okay. What he's also done, which I really liked, was he went through the downside and he looked at the last big drop any of those had and what percentage that was and what potential loss that would mean, to make sure that he was aware of potential losses and what that would mean for him. He looked at the recovery time for that loss then to be recovered. And we do that in the hedge fund industry when we're pitching to pension funds and rich family offices, we actually show them recovery times and potential drops. So he'd done this setup, so it managed his expectations that, oh, it could mean this, it could mean this, it could mean this. That allowed him then to work out, does he want 15%? Does he want less? Does he want more? Then he set up a stop loss based upon what he felt he was comfortable with. This isn't going to be suitable for everyone. Other people will have different stocks. Other people have different allocations. They will not even have these stocks necessarily once they look at these things. The reason I wanted to show this is because I thought, actually, this is rather useful. A bit like, when you're at school, okay, as well. Sana, I'll talk about Tesla a little bit later on. It's one of those where I'd been in, then out, and I'd mentioned it on YouTube when I got out and why, and I'll explain to you in a second why. And then after Trump, not before, after. I didn't want to gamble on him winning. It's not how I do things. After Trump, I'll explain why and how I got in, and I'll explain that one again, and why we were out for a long period of time, why we were in again. And I'll explain that in very simple terms. We don't trade our investments, but I'll explain that going forward. This isn't mine. This isn't mine. This is one of my Great Investments Program clients, okay? So I wanted to show that to you. This is from Goldman Sachs Wealth Management, and it might help you if you've got years to retirement up here. Now, if you're like me and your wife tells you you've got 25 years to retirement, you might say you're here. Most people would say this is a bit conservative, okay? So if you've got 25 years, you might say, well, I'll have up to 90% in equities, as I do, which I'm including exchange traded funds in there as well, and the rest in fixed income, by which I mean cash generating about 4.7% interest in my bank account, instant access, okay? Because my bank sweeps it into fixed income, but it's instant access. As well. I just wanted to share that with you because I don't think I've shared that in the past. Okay, the very important factors we're going to go through in this webinar, as well as individual stocks, is I am looking at valuation of companies to be ticked, growth to be ticked, income to be ticked, cash flow, Sortino, alpha, and then I might narrow things down in a tiebreaker at tactics, like see, okay, well, this is an incredible hedge fund which also owns the same stock which ticks these. Let's use that as a way of narrowing down even more. I would say monitor infrequently so you don't end up trading your investments. And essentially, you're holding for 12 months, okay? You are holding 12 months. Typical stop loss tends to be about 25% from entry. And you will have, say, between 15 to 40 stocks, maybe 20 to 40 stocks. You might have a basket of 5 exchange traded funds in there. That really makes things simple for clients because it means they don't have to have multiple strategies, lots of Excel tabs, and it doesn't become a pain. All right. Excuse me a second. Why do I say 20 to 40? Well, because company specific risk diminishes and then plateaus. There's no point in having hundreds of stocks. This is why funds underperform, because they have hundreds and hundreds of holdings. Okay. Excuse my throat. I really do apologize. So the moment you start speaking, you start getting a frog in your throat. Now, the only way to remove market risk, which you have to do about once every 7 years, is to get out of the market. 2022 was a classic example where in January of 2022, I said, look, there isn't anything which looks particularly attractive. Let's wait till February. And then February, I said, let's wait till March. And March, I said, let's wait till April. How? Well, because when I pulled up something like this, by the way, is the FTSE 100. And you can see it's FTSE 100 stocks. You can see how few meet all my criteria. They've got to tick all these boxes. These first 5 all have to be green. You can see very few actually do that. Okay, which is why I go for US stocks, because there are very few UK ones. You can see why UK fund managers in your pension perform so poorly, because there's very few companies that would tick all the boxes. And if they're only picking from this small list, you can see why they do poorly, because I'm picking from a list of 10,000 companies in my SIP and ISA. They're picking from a list of about 100, because their funds are so big they can't go outside the FTSE 100 usually either. Okay, so I'll come back to that in a second. So nothing was looking attractive in 2022, January, then February, then March, then April. Before you knew it, was the end of the year, and we ended up holding cash most of the year and inadvertently had no market risk, and the market fell 25% that year anyway. So we were holding cash, so we did better. The point is, once in 7 years, you need to do that. Your IFA fund manager will never tell you to hold cash because they won't earn fees if that happens, which is another reason why you can significantly outperform them. And the classic example I give people By the way, all of this is in my books. Barclays did a book launch. I will, for those who are on the webinar, and you access that through, for those on TikTok, you access that through alpeshpatel.com/latest shares. I'll post the books and the downloads up in a second. But what I want to show you right now is that classic example of why, just for those who don't know, fund managers end up letting you down. And here's the example with Meta that I always give, because it was a fantastic example that actually happened year after year. Yeah, this is 2014. Year after year, you think you're doing well. Your fund manager goes, "Oh, aren't I awfully clever?" At this point, you're buying your second home in the Bahamas because your pension's going up. And then, of course, in 1 year, it goes down, and Scottish Mortgage Investment Trust loses 50% of your pension. Okay, or Blue Whale loses 27% of your pension because they won't ever go into cash because they're not allowed to, because they can't charge you money for holding cash. And the IFL never tell you to go into cash. We'll just try and give you stories to hold on because they've got to pay school fees. Well, you've got to pay their kids' school fees. So what happens? Well, you've just lost from 2022, you've just gone back to 2016. You've just lost all those gains. Okay, I didn't know it was going to be a 67% drop. What I knew was, one of the things that I mentioned in my book that I look at is the average prices and the momentum, and not just across one stock, but across the board. And they were all showing the same decline in momentum in short and medium term average prices, which is shown by this here. So we knew to get out. Now, in January of 2023, that had stopped and momentum was rising. We knew to get in. We'd also ticked our value growth income cash flow Sortino box over here. I didn't know in 2023 it was going to rise 155%. Okay, it happened to be January. That's just a coincidence of calendar years. I didn't know it was going to drop 70%. If I knew either of those things, I'd be the richest man on the planet, because I would have gone to Ladbrokes and said, give me odds of 1 billion to 1. However, the point I'm making to you is, when the IFA says buy and hold, because look, it came back. Yes, you made 0% over 2 years. We made 155% over 2 years. It's an extreme example with Meta, which actually happened, and Meta is a stock we all know. That's why this is an important one that I keep showing people. Okay, and that's why your IFA and wealth manager will mess up, because every so often they'll keep growing, and then in the 5th or 6th year lose all your money. Well, not all your money, but a substantial amount of it. Right now. Let's get back to the markets and where we are on things. And I'll try and keep an eye on the questions, which I'll keep an eye on, but I will come back into these. So feel free to answer your questions as well. Most like ones to hold forever. No, John, I just showed you Meta. Is that hold forever? I just said to you, if you held that forever, why does that look like a hold forever? There should be no hold forever, because things like COVID happen. Things like 70% drops happen. If you held that forever and said, oh, well, I made 0% after 2 years. Well, by this stage, when your pensions drop 70%, your wife's already divorced you. So you can hold that stock forever, but you can't hold your spouse forever. You do not want to be going through that kind of a storm. This is the simplicity that the IFA tries to show you. You made 0%, had a bloody heart attack, got out of intensive care in the ICU unit. We got 155. You got 0. And there's a big difference. And it's those differences that make the difference between going insane in your personal life, your portfolio, and actually keeping your gains. It's like snakes and ladders. You just got to try and avoid the occasional snake, which might happen once every 5 years. You think, oh, it happens once every 5 years. It's fine. No, that when it happens, you lose your mind. So that's not buy and hold forever. And those weren't the ones that they necessarily hold. It was just that particular client I showed you wanted some of the big ones because they were performing. But I'll give you some outside of that as well, which have done rather well for clients as well. Personally, I don't care if it's a well-known name or not, as long as it delivers results. This is some of the things that are coming out at the moment. As you can see, reiterates JP Morgan, they're going for the usual big names. And guess what? If they generate returns, so be it. There is a group of people who poo-poo anything that they've heard publicly, which is fine. So they sit on the train station going, well, no, that train looks like it's gone, and of course they miss those gains. I am not a snob on these. I don't mind holding the obvious ones. I don't mind holding some of the non-obvious ones, and we'll come to some of the non-obvious ones. Now, how does the S&P look, given that we've had back-to-back over 20% gains for the last 2 years? Okay, we've had phenomenal returns for the last 2 years. Can we do it for a third year? Well, the data suggests Yes, more often than not, if you've had 2 years where there's been back-to-back gains like 2023 and 2024 over 20%, which is where we are at the moment, then there is a strong probability of that happening again. However, let's be clear, do not mistake coincidence for causation. Also, the past does not guarantee the future. This is not physics. Even in physics, gravity is not guaranteed in the future. Those who know theoretical physics will know that. So the past doesn't guarantee the future, but it may well be something of a guide, you might agree, right? So 2025 might be okay. Now, personally, I don't care. I'm not trying to sell you a retail fund. I'm not a brokerage. I'm not an IFA. I'm not a wealth manager. I don't care. I'd like it to go up, but I don't have to talk it up. I don't have any bias towards it going up. If it doesn't happen to go up, great. I take the Warren Buffett view. Fantastic. If it doesn't go up, I'll just be able to get other things cheaper and I'll make my money in year two, not next year. It might be the year after. I'm 53, trying to stay healthy. Life is long. So quite frankly, I don't care whether it goes up next year or not. I hope it does for the sake of my pension. Like everybody else, I have an element of greed, but if it doesn't, don't care. I'll catch it the year after. Okay. US equities are undeniably expensive. Just watch that. And that's been a problem I'm going to show you in a second. This is the price earnings ratio. In other words, you're paying for US equities, you're paying on average about $24 for every $1 of expected profits that a company delivers. So imagine a rental property which generates or is expected to generate a $1 in profits over the next 12 months. To buy that rental property, you're paying $24. And you might think, bloody hell, a few years ago I was only paying $14. That's right. That's what I mean by expensive compared to either the rest of the world or its historic average. You can either compare it to other things or back to itself. So yeah, that's what we mean by expensive. But you might say, hang on, Alpesh, thanks to AI, growth is projected to be far more significant, so we shouldn't worry too much. That is a line you can take. Okay. But it's given us some caution. It's made it a bit harder to find companies, I have to admit, on value, growth, income. We factor in momentum as well, thankfully. That's one of the factors. The reason we look at momentum more heavily than I think anybody does in other fields, as well as looking at value, growth, income, is because momentum comes from the hedge fund industry. So if you look at Jim Simons, Renaissance Technologies, the most successful hedge fund manager in history of the world, more successful than Warren Buffett, but doesn't get the PR, passed away sadly this year. That is largely a momentum-based fund. J.W. Henry, who owns Liverpool Football Club, momentum-based hedge fund manager. Okay, so that is one of the reasons we tend to look at momentum, i.e. trends, more. But we do look at value, growth, income. We need all those boxes ticked. Okay, not just one of those. I know it can be difficult for people sometimes to understand because they've got to hold more than one idea in their head at the same time. So you might find it difficult, but it's value, growth, income, cash flow, Sortina, momentum's in there. Now, the most crowded investment ideas, which of course does worry us when everybody's looking at the same direction, that is a worry because historically that doesn't tend to work out well, which is why we will be looking and keeping a very close eye to make sure when this 70% drop happens again, which sooner or later it will, that we'll be looking, and that's why I do weekly updates so my clients know it as well, that we know when to exit. And it might happen, well, it'll happen whenever it happens. But the easy trade, I've not known a time since the dot-com era where the easy trade, the obvious trade, has been the one in the right direction. And nobody's handcuffing you. You know, people go, oh, I don't want to be in that because it's overvalued, it might fall. Yeah, nobody's handcuffing you into hold. It's not the Titanic. You know, you're not Leonardo DiCaprio where you have to just stay and drown yourself. You can jump off and get in the lifeboat and leave the girlfriend behind. Okay, so that's the advantage of controlling your own portfolio. A fund manager can't do that because they can't go into cash, right? So whatever they hold, when the markets fall, all things get correlated to the downside, as I've written in my Financial Times columns and shown the data on that in the past. UK funds risk tax. This is what some of the news headlines over the past week I just want to update you on. UK funds risk tax hit for under investing at home. Basically, and this is from Bloomberg, there is some worry that the UK government might remove tax breaks on pension funds if those pension funds don't invest in the UK. Now that won't affect you if, like me, you make your own investments into SIPs and ISAs or through a SIP and ISA into individual stocks or exchange traded funds. This will affect you if you put it into British based funds, which is what your workplace fund will be in. It's what your St James's Place piss poor performer is in. This hasn't happened yet. That's coming from Bloomberg. I used to work at Bloomberg. Trust me, if it's come from Bloomberg, there is strength behind it. They don't just screech and scream for no reason. Another bullish call for stocks in 2025. Wells Fargo raises the S&P 500 target. Now, if you're a contrarian, you might say, well, all this positivity, I'm going to go short as I did last year, the year before. I know I'm nearly bankrupted by going short and staying out of the market, but I'm just going to do the opposite. That's entirely up to you. It's not data-based. It's not data-driven. This is just for information to give you some background on what others in the big banks are telling their wealthiest clients. And I can assure you, for the conspiracy theorists, Wells Fargo and Goldman Sachs and everybody else don't tell the public one thing and then tell their private clients something secret. I know this because I know the people at these banks and what they tell their wealthiest clients. Okay, Reuters, Dow futures hit all-time high as markets Lord Trump's treasury pick. Okay, so that's what the background we're getting into, and this is why getting ready for 2025 right now is important, especially as Christmas approaches, gets a bit quieter. It's a good time to sort out your pension as well. Sana, Marguerite, thank you very much. I will answer those questions. Ross, John, I've seen those as well. Now, have a look at that if you want the free videos, the free books, free courses. It's all free on there, alpeshpatel.com/links as well. So just a reminder, the free book, Investing Unplugged, which was an international bestseller. I've got about 18 books published by the Financial Times and others. It's on there. Okay, so let's have a look at where we are with the market. Now, as I said earlier, you're paying $28 for every forecasted dollar of profit in Microsoft. Okay, you're paying $28 for that. So that is expensive. However, you're paying exactly the same, by the way, for Apple. Isn't that a coincidence? Amazon, quite similar. Alphabet looks relatively cheap. And you might say, well, surely that's to do with the news about a split and all the rest of it. Well, we're not going to speculate on that part because we're not going to speculate. It's my pension, my son's junior ISA. We're going to look at the data. Valuation is not the only factor that moves stock prices. How do we know that? Well, Nvidia's been read and overvalued for donkeys. Growth, which is why we don't just look at value, we look at growth. Your typical St James's Place fund manager will talk about value because they've learned from textbooks from the 1960s. I know this because I know those fund managers and I know what they've learned, and I'm more qualified than any of them, so I can tell you their education has a massive gap. Okay, Nvidia is expensive, but it's the growth element. The momentum is important. Now, people poo-poo that. Oh, momentum, oh, stupid, shouldn't look at momentum. Actually, it's what the hedge funds look at. If you look at AHL, you look at Winton Capital, the reason some of these hedge funds are in those is purely because of the momentum. They don't care about the narrative, the story, the AI, which is what the journalists might care about. They care about one thing, momentum. Okay, and I'll talk about momentum as we go on and why that's an important factor in our selections alongside value, growth, income, Sortino Alpha, and often overlooked. So that's where we are in valuation. All looks very expensive, but it's looked like this a year ago and 2 years ago and 3 years ago and 4 years ago. So I'm not particularly worried, right? Earnings calendar, S&P 500, what's coming up? Well, you got Salesforce. It's not going to move the market. You got Dollar Tree, very quiet now. It's getting quiet as well. Jeffrey asked, why is Tesla so high? Well, it's not actually compared to historic levels, but we'll come to that again. It's forecasted growth, anticipation, it's momentum, it's trend. It's not based on valuation. And it's also the fact that he's best friends with the president. And if you are best friends with the president, you know that old saying, your stock is high, Mr. Bond. Your stock is high, yeah, because when you're best friends with the bloody president, people are anticipating all sorts of things. Now, value growth income, as I said, those are the things we're going to look at. Over the past week, this is what's happened. It's been another bloody good week. Well, I don't care what happens in a week. We are not here to trade our investments. So I don't care. I don't lose sleep. Oh, it dropped 6%. What does it mean? What does it mean? As Warren Buffett says, and the man, there's very few people, there's only 2 people on the planet. Every single thing they say is just always correct. Actually, there's 3. 1, Warren Buffett. I've never seen a video of his where he said anything stupid, ever. 2, Rory Sutherland. Okay. 3, my wife, because she tells me everything she says is absolutely correct and gospel. Okay. So if we start with the first 2, and he says you don't just keep looking at the things every single day. And I don't, because underlying it, this is an investment. When I'm trading, yeah, might be 5-minute bar charts, but that's a different story. So it's been an easy week in many ways. Okay. And this is all the Trump effect. All of underlying that is the Trump effect, his Treasury appointment. I've done that in the separate broadcast, which I'll upload on YouTube and TikTok tonight, the part 1 of the weekly update, where I go through the macro news and use all my I have a master's degree in economics as well, so I use all of my own knowledge as well as what I see in going through the hedge fund industry and all of this. Over the past year, yeah, it's been an easy year. I don't deliver phenomenal results, just so you know. I don't deliver those. These companies deliver them. My job is to be exposed to them, and my job's a hell of a lot easier when there's a lot of green, because it means, think about like as if these were landmines. Okay, well, there's very few reds. Good. Do you know how you get fewer reds? You increase that time frame, right? Why do we look at 12 months? We look at 12 months and then reassess, because 1 month is too short and 10 years is too long. Imagine, oh, let's buy and hold forever, Alpesh. Well, just imagine the stupidity of that statement, because it means you're looking at today's set of accounts, and given that the American companies report 4 times a year, the UK twice a year, and you're saying, based on today's figures, I'm going to commit to something for the next 10 years, despite the fact that I know COVID, AI, all these other things, Trump, all these things can happen. I'll ignore all of that. The stupidity of that's extraordinary. Even Warren Buffett reviews and rebalances and sells and buys different things. If it was buy and hold forever, how come he didn't have Apple 30 years ago? And how come he's reduced the holding on it? So even he doesn't do buy and hold forever. The ones he's bought and held forever are Coca-Cola from 1960, because at that time you could pick up so much of it and get a great dividend yield. Anyway, separate issue. So past year has been this. ETFs, separate webinar, I'll come on this, including possibly a separate one on crypto. I hate mentioning crypto, because if you ever mention that on social media, you get a bunch of fraudsters and scammers going into your comment section pretending to be you, direct messaging clients. And it's not me. I do not direct message clients and have a 2-way conversation with them on TikTok. 1-to-1. I do not have 1-to-1 2-way conversations with people on TikTok. Okay, I might post on a comment section broadly, but I do not tap you up on your inbox. Okay, that's somebody who's using my photo and my name. I was at the Crown Court as a witness to one prosecution last week. Okay, so we are going after them and starting to prosecute. Okay, on that front, just so you know. US sector is this. We'll go into some of these exchange traded funds. The advantage that the exchange traded funds have, because they're a basket of stocks, they tend to move more smoothly. Now, people think, oh, well, a basket of stocks moves more smoothly, I'll get less returns. Well, actually, not necessarily so. You won't necessarily get the 200% NVIDIA, because it's rare for an exchange traded fund to move up to 300%. But the downside volatility, the drops down and the recoveries tend to be shallower drops, quicker recoveries. Shallower drops, quicker recoveries. It's something I've explained to my Great Investments Program people, because they're a basket. And I've probably undersold ETFs more than I should. I first wrote about them about 25 years ago in an FT column, and they'd been around for 10 years before that. And I said, look, I just absolutely love ETFs, but I think I've been underselling them somewhat and their benefits compared to individual stocks. And I've discovered for a lot of people, exchange traded funds are actually more suited to their personality than individual stocks. But the reason they don't do it is because they think if they have crazy volatility, crazy risk, they'll make more money. No, higher risk doesn't necessarily mean higher return. It just means higher bloody risk. You can cross the road with your eyes closed, i.e. take more risk. Doesn't mean you get across quicker. It just means you were bloody lucky. You didn't get hit by a car. Okay, the desire for lower risk means you'll have less choice, but that's fine, because you only need that's why you need a big choice of 10,000 to begin with, because you're going to narrow it down, and you only need 5 to 10 ETFs in your portfolio, or 20 to 40 stocks. Okay, and that's something people don't often understand. US market price to earnings ratio. This is what I was talking about. It's a bit expensive. I'm going to come to individual stocks in a moment and what I see. Apologies. I've given so much information on this. Okay, total earnings 1.9 trillion. Now this is the earnings bit. Earnings are not rising as quickly as prices, okay, or market capitalization. So the American stock market is worth $62 trillion. Just to put that into context, that's 3 times the national debt. Okay, the national debt in the US is about, I think it's about 20 trillion, but somebody can look that up. The last time I looked, it was 20. It might be 22 now, or 23. Somebody, if you could look that up for me, please, what the US national debt is. The total market cap of their stock market, 62 trillion. One reason why I'm not so worried about US national debt, okay, because they keep creating incredible value out of which they then create shed loads of earnings, out of which they then create shed loads of tax and jobs which pay tax. Okay, so yes, that's expensive, and I'm mindful of that, which is why I'm not gung-ho crazy. All right. The most expensive subsectors, if you want to have a look for your interest, take a picture of this if you wish on your cell phones and the like. You can see some of them there. Just want to make sure my people on TikTok can see all of that as well. Hopefully they can. And forecasted growth. Now, I'm not going to read anything into that for the simple reason I don't do what's called top down. I start with a sector and work my way down for reasons explained in my books and the academic research, which shows everything that I do is backed up by academic research. It's not done by me just plucking something out of some magazine. Okay. I do bottom up. I look at the individual stocks and look at the quality of those. Again, it's a sort of Warren Buffett approach. But that's just out of interest. For people who want to look at it, you can do it later. We can't discuss everything, so we can do that again. Oh, it's 36 trillion now. That has gone up since the last time I looked at it, but still half the value of the stock market. Actually, I should have known that because there's a Warren Buffett indicator where he looks at the market cap versus national debt, I think. Anyway, or size of the economy. Anyway, we'll do that separately. US market. So this is just to show you some of the top gainers. I don't care that some of the top gainers happen to have been names in the last 7 days or 1 year, the same old names. Now, it might be that next year it's going to be none of these. Okay, I don't care that it's, there's a scene in the fictional TV show Billions where one of the analysts is asked by Axe to give me a stock idea, and the guy goes Apple, and he goes, do you think we're paid the big bucks to come up with Apple? Okay, personally, I don't care. Apple's the largest holding Warren Buffett has. You can be paid the big bucks to come up with the obvious names. Who cares? But yeah, I am mindful of these things, right? So we'll discuss some of this in more detail. This is the UK market, cheaper, but then again, less growth expected. And in fact, one of the biggest problems that we've had with the UK is, first of all, market cap has barely budged this year. And in actual fact, total revenues have dropped on companies and profits have significantly dropped on companies. Okay, and that's got to be a worry, which is why my first column in the FT, I've said this a billion times 25 years ago, first column 1999, and I'll show you later, said I'm shifting to US holdings. Okay, and there's not been a year where I feel what a stupid idea that was. And that's an example of why. So that's the UK one. If you've got earnings dropping, I used to say this on my Bloomberg show during the dot-com era. I said the dot-com rises are a momentum-based bandwagon. It's fine to ride it and make your money. Because the earnings are not there, when the bandwagon starts dropping off the cliff, jump off, a bit like Indiana Jones, because it doesn't drop 30% in a day. Okay, you get ample warnings. 1987 can't happen again for the simple reason that they put circuit breakers in. Now, price to earnings to give you more time, give grandpa more time. This is the UK market. All right, price to earnings, which is a measure of valuation. These are the most expensive at the top, but these are the forecasted growth. Now, I'm not going to read anything into this because I don't base it on sectors, right? But I just want to share this information with you. I think it's useful. Hopefully, you'll like it. ETFs, absolutely, Sean. I will do a separate one on that. Thank you very much. Your take on XLP in early this year was spot on. Thank you, Sean. I appreciate it. I will do more on exchange. I think you're actually, Sean. Yeah, that's spot on your part as well. Somebody just said no sound. Can you all hear me? Okay. The sound should be there. I've not touched anything at all. So let me know if for any reason sound has stopped. Now, the UK market, these are the biggest movers over the past 7 days. I'm not going to go into that in much detail, right? Markets year to date, just let me know, sound is fine. Okay. Year to date, the S&P is up 26%, Nasdaq's up 24%. Good. The Dow is up 19%, the UK is up just 8%. And that's your typical problem. If your pension fund, IFA, or fund manager is giving you, 3 points above what I can get from bank interest, 4% more than what I can get from bank interest, and your ambition is, I thought it's all right, got a bit better than banks, then that's why our British pensioners are so much poorer in the UK, besides a whole bunch of other reasons, than the American equivalents. An American pensioner, if they've just matched the market, that's all, just match the market, just tracked the market, nothing else, nothing special, nothing clever, no individual stocks, no Bitcoin, no Nvidia, forget all of that, then the British pensioner has got 4% more than what they could get in a bank account. The Americans got 26%. Their pension's gone up by a quarter if they just track the market. Nothing else, just track the market. You tell me, and that's this year. Last year, the Nasdaq was up 55%, and the S&P was up 25%. So, right? Okay. Somebody said, if no sound, refresh page and click and touch for sound. No sound is too. Well, that's weird. Yeah, please refresh if no sound. Thank you for that. I will broadcast comment to room. If no sound, refresh page and click touch for sound. Sorry, apologies why it's done that, why the system's done that. Okay. So what's been doing well year to date? Well, financials are the ones which have actually pushed the market higher. They are up 37%. I continue, just so people know, for full disclosure, continue holding Goldman Sachs and JP Morgan. There was another bank I bought this week. I will come to that in a second. I'm sure there was another bank and I've forgotten the name, but I will come to that. I'm sure it's in the program. It's in the presentation a bit later. Communications, 35%. Utilities, 33%. Now, I don't bet on individual sectors, as I've already said, which one of these horses from January is going to win the race or be the biggest mover. I look for individual companies, and hopefully we'll have enough JP Morgans and Goldman Sachs's in there. Communications, I think communications includes Meta. Meta doesn't go into tech, apparently. It's a communications company. I think if I'm right, that's why I don't like looking at these labels, because they're often just so bloody wrong, or not what we commonly associate with them. Okay. In terms of factors, momentum, there, look, what's been the biggest factor which has led to stock price movements? Momentum. It's not talked about. People go, huh? What? Momentum? No, talk to me about value. Talk to me about growth. Your IFA wealth manager will never talk about momentum because the blooming fools don't even know what the hell it means. They won't talk to you about Sortino because they'll go, what's that then? Trust me, I got Paresh, who works with me. He was he developed all the strategies for a $2 billion hedge fund now, from day one, and was one of the co-founders. And I said to him, just pull up one of these IFA exams, will you? What the hell are these numpties learning? So he pulled it up and said, you're not going to believe this. They've got textbook examples from the 1960s and 70s, and it's a multiple choice exam where you've got 5 choices, okay, and you only need to get 75% to pass. So hang on, you've got 5 choices. You can be wrong 25% of the time anyway. So let's do the maths on that. The chances of failing that become slim. Okay. So my point being, any numpty can probe your pension and mess it up. Markets 1 year, S&P is 32%, the Nasdaq's 30, the Dow is 26. So that's over 1 year, not year to date, over 1 year. However, I want to point something out really important to you. The reason we look at 12 months and not 6 months and resist the temptation to trade is this. Markets can do 4 things, one of 4 things. Okay. The reason why it's important to sit on your hands most of the time over a 1 year period, and then of course next year you might still hold the same stuff, but at least you've reviewed it after a year. A bit like your annual review at work. They don't do a bloody daily review, do they? Unless HR's on your back for whatever reason. Okay, they can do one of 4 things. They can, of course, go up, which is what we want all the time. I wish that was the only thing it did. It can go up and fall back. Okay, it can fall, or it can just go sideways for prolonged periods. And there's an overlap between these. Obviously, I appreciate that. Right? Prolonged periods of just going nowhere. So 1 times out of 4, it does the one thing you want, which is just to go up. 3 times out of 4, it's giving you nothing. It's giving you nothing 3 times out of 4. Yet, that 1 times out of 4 where it's rising is what delivers the 32% return. Now, look at that chart. People find that intellectually very, very difficult, what I've said, to understand. They stare at it blankly and go, what? So I simplify it for them. I say, listen, hold for 12 months, then review. Okay? Because then they don't have to understand the subtleties of what the hell. How can you have something going sideways? I'll give you the best example. Microsoft 2021. It spent 9 out of 12 months either producing a 0 or a negative return. Do you know what the return for the whole year was? About 50% up. What? How? Exactly. And it's not because it went flat for 9 months and then up like a hockey stick for 3. I'm talking about in aggregate 9 months, 0. 3 months was where the results came from, which is again why Warren Buffett, the genius, says you don't keep staring at it, you don't trade your investments, and you look at it over a period of time. Okay. And I've had Microsoft for years, almost close to forever. Well, 8 years in the last batch, the last sort of period I've had it. This is the FTSE 350, those 350 largest UK companies. Price percentage 1 month ago. These are their moves. I'm not particularly going to talk about these. Okay. I want to now go into more individual ones. This is a new thing that I've started doing for my Great Investments program, where we look at hedge funds which have generated 40% returns for 3 consecutive years, 40% or more for 3 years. Look at their picks and see which of them tick my filters as well. Now, worst case, if you think, well, your filters are rubbish, fine. No harm to put it through my filters. If you think, well, hedge funds are rubbish, fine. At least they meet my filters. Okay. So either way, it's a pretty good thing to do. And so let's have a look at which ones. And some of these might be what I call special situations or not. What I'm looking for any of these is the hedge fund has to have returned 40%, have over $1 billion in assets, must hold at least 5% of its money in that stock, so really be strongly committed, not a spray and pray approach like your fund manager in an IFA might do, and at least a 40% reasonable target in 12 months based on an existing trend is feasible. And then I look to see, does it tick my targets? If it's a special situation, it means it does tick mine. If it isn't, that means it doesn't tick mine, but you might want to consider it anyway. So let's look at this particular one from Abdeel Capital Investors. They've got $1.65 billion under management, significantly more than I have. So you might say, well, I don't want to listen to you, Alpesh. I'd rather listen to that chap. Good for you. Okay. They've gained 637%. Anyway, their average return is 73% over the last 3 years, 73% per annum. Okay. 73% per annum. Right? That's the S&P, that's the hedge fund manager. Now, massive volatility there, heart attack. So I'm not suggesting you'd want to be in, because if you got in there, you've not made your money back, you're screwed. But let's just have a look at what they own at the moment, just for ideas. Okay, just for ideas. That's what they've got. Now, I don't like all of those because a lot of them don't meet my criteria. So let's look at some specifics. This isn't a 7, 8, 9 on my value growth income. So it can't be a special situation. So it becomes a non-special. The only reason this could possibly meet, other than the hedge fund manager, and if you care about what Goldman Sachs think and all the rest of it, would be on momentum. So I would put this in the high risk category because it doesn't meet all my criteria. And I would say if somebody did want to do this, it's outside of my Great Investments program, what I'd put in my pension. However, that would be the project. You might disagree with that projection, but you'd probably want to put a stop loss here, maybe even down here. And you'd look to say, is the upside projection at least twice the downside? And if the stop loss gets hit, i.e. the price shouldn't go down there if it's going to go up here, you don't lose more than 1% of your entire portfolio investment. And that's how you decide how much money to put in. Your risk management is, that's where you'd exit, because if it drops that far, then it's clearly not going to go in that direction. You might even get out at that point. No point putting a stop loss right next to where the current price is, because that'll get stopped out by noise. Got it? This is Bill. In case you want to know what they do, mid-sized businesses, financial operations worldwide. Not one, as I said, which would fit my criteria. That's come out of the fund. HubSpot. Now, ad tech, advertising technology, is doing rather well. And it's doing rather well under Trump as well, because there's expected to be quite a bit of deregulation. Now, if you agree with that projection, which is based on previous historic growth and that trend, if you do, and you might disagree with me, you'd probably put the stop loss there. You might even put it here, okay? And you'd have to make sure that that is giving you a twice reward at least to that. Now, it isn't a 7, 8, 9, or 10, but I can see why the hedge funds got it. They might have it for other reasons. Who knows? Maybe they've got some inside information. God knows. Okay. But for me, I have more stringent criteria than they do. And you might as well, you fool. Fine. I'm just showing you what they've got. You can go with, it's like picking football. So you can join their team if you wish, or you can join mine. Doesn't quite hit it there. Cloud-based customer relationship, CRM. I put HubSpot less on the CRM, more on almost ad tech. Anyway, earnings are forecast to grow. Well, that's presumably somewhat priced in the stock at the moment. Let's look at another fund. This one's got 4 billion, so far more than the other one. He's been generating 53%, and he's been doing it more consistently without massive drawdowns. Okay, so a bit more sort of sensible. You could pretty much gone into his at any point, and you'd still be up, right? What does he hold at the moment? Ooh. No, I haven't put his on there. I'll put that on the, I think I might have it later, or I'll put it on the Great Investments Program. Oh, by the way, with the other ones, for those who are on the program, you'll get my analysis of all of these on the private Telegram channel. But I just want to give 2 examples publicly. And similarly with all the ones he's got, I'll put it on the private Telegram channel. Probably not tonight because it's getting late. S&P 500, this is where we are. We're somewhat overbought, as we know, but what's happened is it's broken into all-time highs at quite a steep angle. So it looks like this might continue. If it were to continue, then you can see the gains could be ridiculous. Now, I am loath to say that it is going to go up that much next year, because that's scary. Why would I put my neck on the block and say that? I would, if I was on the BBC, say to you, that's what the projection looks like. It looks highly optimistic. Just be careful. We are due at some point what I call a daddy bear, that fall. By the way, I want to show you this. Over the last 10 years, every single July, my birthday month, the S&P's risen for the last 10 years. Doesn't mean they'll do it again. I'm just telling you. Okay, and November's always been an up month, pretty much. Anyway, September. I mean, I'm not saying seasonality-wise, you buy in the months where it's more than 60%, 80% likely to go up, and you triple leverage on it using an exchange-traded fund, giving you 3 times return. But I want you to consider this. That return there, 33%. If you used a 3 times leverage S&P ETF, which I don't recommend people do, that means you get, if it goes up $10, you make 30. If it drops 10, you lose 30. But there's also something called decay. Anyway, you'd have about a 70% plus return this year. You know, when people say, can you beat the S&P? Yeah, it's really simple. I already hold some S&P triple leverage since January of 2023, because I've been focused, well, I've been showing you this since then, that was the point at which to get it. I think it was January or February. Okay, so that's fine. Just buy it when it's not a daddy bear, and do 3 times leverage. Simple, you've beaten it. And in fact, I had one student who said to me, Alpesh, hang on, you talk about all these stocks and everything else. Why don't we just do that? And I said, yeah, actually, shh, don't tell everyone. You actually could just do that. Okay, it's a little secret. NASDAQ, same thing. You can actually get 2 times leverage on this. And if you did that since then, and just have it when, if the MACD is rising, which is like there, you're in. If it's a daddy bear, which means falling at a steep height below its own moving average from a height like that, you're out. Okay, so you're out during those periods, you're in during those, you're still in. That may well continue up there. Rarely it breaks above its moving average and continues higher. That's momentum. This is just all pure momentum. It's not even based on valuation. You can try and justify it on growth and everything else. When we used to have our show on Bloomberg TV, what would happen is Sally and I would look at something like this. I would say, look, it's momentum. And then I'd notice that the journalists would ex post facto try and justify it by saying, well, surely it's based on projections of growth and this. And I said, yeah, well, you're making all that up, but yeah, okay. It's momentum. Money flows into the direction of the trade, and that's what the biggest hedge funds do anyway. They're not trying to outsmart anyone. They're just saying, went up yesterday, it'll probably go up tomorrow. Okay, that's Renaissance Technologies. Started investing at 40, did Jim Simons, and died with a fortune of about 40 billion or something ridiculous. Or the fund was 40 billion. Anyway. NASDAQ 100, okay? FTSE, well, it might bounce off its own moving average and pop up a bit. we'll see. It seems like it's just going to keep going. I mean, it's gone sideways for the last 6 months. Top 10 S&P 500 stocks. Let's look at some of these. I'm mindful I've taken a whole hour of your time. Forgive me. Do I put the stop loss on initial purchase? I don't put one into the market because I don't like. I know where it is, and I keep monitoring it every 2 weeks. And then I don't like to put it in with the broker on day one because some brokers might have bad prices, knock out a stop, and they're relying on clients to call them up and complain. A lot of brokers do that. It's not officially a scam, but that's what a lot of brokers do, even the regulated ones. They'll just say, oh, it's an IT problem. Funnily enough, they've all been making lots of money out of it, and nobody in management and in the board are bothering to take too deep a look. And as long as they've got a complaints procedure, the regulator will leave them alone. So over the past month, so let's have a look at some of these and make sure we're not missing anything on these. Okay, over the past month, these are the biggest moves on the S&P, and then we'll look at some more of the stocks meeting my criteria and so on. So this is Palantir. Now, I mentioned cybersecurity in the conferences I'm doing, and I know this is important. We're at World War III, in case you don't know, in particular with China on cybersecurity attacks, and now with Russia. They've joined on board. Well, they've always been doing it, but they really are aggressive. And if you don't believe me, just look at some of the public announcements from the security agencies of what's called the Five Eyes: Canada, New Zealand, Australia, United Kingdom, and the United States. But I can also tell you with my work from government, and it's no secret, we are at World War III on cybersecurity, and their attacks on our national infrastructure in America, in the United Kingdom, and nothing would please them more than one of our nuclear power stations shutting down because of a cyber attack, or preferably the NHS and so on. So companies like Palantir and indeed Microsoft, their job is to make sure these things don't happen. People don't realize Microsoft is a cybersecurity company. It's also an AI company. It is not an online stationary Excel Microsoft Word company. It's moved way beyond that. Okay. Cloud, obviously it has, and AI through Azure and so on, but it's a cybersecurity company to a level people don't actually quite appreciate, as is Amazon. Okay, because they provide governments with a lot, and the government contracts are the biggest contracts you're ever going to get. Anyway, Palantir. I would love to own this. My problem is overbought, and it's not 7, 8, or 9. Now you might say, well, you fool, you're missing out. Well, fine, be my guest. You can buy it if you wish. You might want to put a stop loss there. You might want to agree with that projection, or you might tone it down and say, well, 100% in a year, and your stop loss is there. So you've got a multiple upside to downside. That might suit you. The point I'm making to you is this: it is not about what Alpesh wants. Therefore, I'll just blindly follow him. Don't blindly follow anyone. I mean, basic first day at university. Make your own mind up based on what you see. But similarly, just because I say I don't like it, you might. Okay, based on what I've said, and the Bank of America 2 days ago gave it a buy rating. But for me, I really want to be a bit stricter in 7, 8, 9. That doesn't mean it's going to fall. It doesn't mean it's not going to get 100%. Might do all of those things. It's just that I've got other choices. And what's suitable for me at the age of 53 with a 6-year-old son and a wife 11 years younger than me is very different to what might be suitable to you. And for some of you, this will be suitable. For others, it won't be. Okay, so I'm just giving you the pros and cons on these. Now, if I thought it was an absolute red flag and I'd say I won't touch that with a barge pole, I'd tell you. This is not one where I'd say I won't touch it with a barge pole. It's just that it doesn't tick enough boxes for me. I've got enough choices. Paycom, it's an 8 value growth income. Would be a special situation because I'd be looking at it. You'd say, you're insane. You'd take this and you wouldn't take the other one, even though all these banks say that and all the rest of it. This ticks more of my boxes. The only thing is, I don't like the fact that it's dropped so much for so long, but it does tick our special situation boxes, and I'll go by saying, oh, surprised. And some of my students won't like that volatility. It drops 31%. Now, I'll tell you why it's important. And you remember early on, I showed you the Excel from one of the clients where he looked at the last drop or major drop and potential loss and time to recover, and why that's important. When you look at historic drawdown, I don't mean on a downward trend when that momentum's falling. I'm talking about on an upward trend. You look at the drawdown. Your due diligence has to be this. The drawdown danger is the depth of a fall and the duration to recover. Depth of a fall, duration to recover. That is how you work out your risk appetite. Anything which is too deep and too long, you don't want. This is why exchange traded funds, which tend not to be like that, can be a better option for most people. So I say to that, I look at that, I point that out to clients, and I think, really, do you want this with that? And they go, actually, you're right, Alpesh, not suitable for me. I'm not in my 20s anymore. Okay. Some of these I'm not going to cover here, both in the interest of time, but also my Great Investments Program clients go a bit berserk if I give too much away on these. By the way, Warner Brothers, it's come up again. This is a tiny penny stock. This is high risk. If you want to put a stop loss down there and you think that projection is feasible, and I probably wouldn't say a year, but if you got that over 2 years or even 3, okay, you might be happy. Not in the program. It's not in the program because it's not 7, 8, 9, or 10. Okay, but I just wanted to mention that one up there as one of the big movers of the week. Some of these, in the interest of time, I've got more to come, but now Tesla. Somebody mentioned Tesla and why I got in. So one of the times we got out of this is when it just wasn't breaking through there. It had risen from. If that's rising, we're all fine. Okay, but if it doesn't then move up, it's like, well, forget it. Okay, so you sort of can exit there, you can enter that. But at the moment, it's broken through. So we've got momentum. We haven't got 7, 8, 9, or 10. But the reason I said I got into Tesla was it's broken through. And also I'm well aware of the background mood music out of politics and what's happening. So that's that. Now, this is not based on cars and landing on the moon. And the reason I don't look at those narratives is the same reason I never looked at it with Apple when people say, well, what else they're going to invent? This is when they didn't have an iPhone, they didn't have music in your hand. All they had was some computers. What else are they going to invent? Well, my view has always been, if you bloody well knew what they're going to invent next, you'd have started Apple or Tesla. It's not your job to outsmart Elon Musk. I don't recommend it. It's your job to say, well, this is a momentum play, Alpesh, not for me, thank you, even though I can see the projection and where you might put a stop. I might not even put a stop there. I might say, bloody hell, he's in the Trump White House. I might not even put a stop there. And that's a 50% drop. So if you're comfortable with a 50% drop, and you'd have to be in a Tesla, because look, 42% happens easily. 57% happened during COVID. Okay, so it's not a buy and hold forever, because that'd be stupid. I showed you on Meta why that would be stupid. Okay, it's a high volatility play, and probably a sort of a special kind of play given the circumstances. So most people will turn around and say, thanks, mate, not for me. I don't want to speculate with my pension. I don't want it. Okay, fair enough. 7. Apple. I'm not going to go through these on this one this week because I go through them most weeks publicly, but I'm going to keep this for the private channel. Bank of America, I've been covering every single week for donkeys. It's one of those financials, and that will be the projection. It's still got a bit of room on the upside. It's a bit like it was when it was here. So you still might have a lot of gas in there. And the financials are well, and I know the other banks in November have said good. So I cover this just as a stock market update. Okay. Netflix, as you know, one I don't own, but I've been covering since that period when it had this big, after it had this big bounce up. And the reason I started covering it then for you is in the weekly update, I wanted to show you things I don't own, but to show you they can still do well. Did I think it was going to do this well? No, because if I did, I would have bloody well said, actually, let me not show off by showing you I'm going to leave this alone and just show you it can still make money. I would have thought, bloody hell, 100%, I think I'll take that. I didn't know it was going to go up this much. So we looked at this at that time when it was also a 7 and the MACD was rising nicely. And of course, it has done this better than I actually thought it would at the time. Because if you asked me at the time, I would have said, well, I'll probably go up to here and then that'll be end of that. But it's actually broken through. Anyway, it's now overbought. I won't buy it today because although it's a 7, it's overbought. You might say, well, bloody hell, mate, why not? Because sometimes when it goes into new high territory, you go, yeah, probably too much more on the risk side than not, and I'll look for other alternatives because there are other alternatives. But I want to show you Netflix because it's a popular household name as well. Eli, ooh, look, lots of buys. Walt Disney is now back. Now, this is a classic example of people picking stocks which don't suit their risk profile and then panicking. So this is an example of a stock which basically went up a little bit, then fell all the way back down, and has now gone back up. Now, if you don't notice the volatilities and don't like the historic volatilities, then this is clearly not for you. And for most people, this is not suitable, even though it's an 8 and it's a household name. They make the mistake and go, oh, it's an 8, it's a household name. And Alpesh said the momentum might go. Yeah, They can't take those kind of volatilities, therefore it's not for you. And I'll tell you now, there is nobody on this webinar where this is suitable for them. For the simple reason they don't want that volatility. Why should they want it? Why would anybody want volatility? So leave it alone. Of course, a year from now, I'll be saying, well, there you go, it's 190, a bit like Netflix, but nobody wanted the volatility. It's better to get the right stock with less volatility than one which doesn't suit your personality. Okay, don't try and make that slipper fit like one of the ugly sisters. So let's look at from the past week. There's a lot we've got to cover still. The big elite banks and their stock buys. Which are their buys from the elite banks? Okay, at the moment over the past week. So by the elite banks, I mean these. Which stocks have they said? So JP Morgan Wealth Management, Goldman Sachs Wealth Management, as well. Born 16th July is a Cancer. I'm 16 and Cancer. What was the third bank? I'm trying to remember. Honestly, I'm not. I'll try and find out. I think I mentioned it somewhere. I'll see if it comes up and jogs my memory in a second. It was a financial stock, and I'll look it up. Okay, so this is where we are with this. Now, I look for these and say, which ones in the past week have they said buy, and do they fit my filter, and have they got 40% reasonable target? So in the past week, JP Morgan Wealth Management said best buy. Okay, that's on their list. So I said to myself, is that a projection? It's not a 7, 8, or 9, and the momentum's good. So wouldn't be a special situation, but it'd be a non-special elite bank purchase. You'd probably put your stop loss there, so you'd know pretty quickly if you're going to be right on this one. And there's your projection. Not bad, 55% to the upside, probably about 10%, 12%, 15% to the downside risk. Okay, for a 55% to the upside if that projection is. If you disagree with that projection, you wouldn't get this. If you disagree with that stop loss, you wouldn't get this. If you disagree with anything else, including with JP Morgan Wealth Management, you wouldn't get it. But I just want to show you structure. I'm showing you risk management. I'm showing you money management. Money management? Well, because if it drops that much, you shouldn't lose more than 1% of your fund. Okay, there we go, Sean. We are birthday twins. And that's Best Buy. You've all heard of it. Trading at 55% discount cash flow fair value. Earnings are forecast to grow as well. That's always good. Pays a good dividend. All good. Well done. BJ's Wholesale Club Holdings. We've had this in the past on the program. UBS in the past week said buy. There's your nice projection. Can you see this compared to a Disney in terms of smooth? Now, I don't care. I don't mind holding a Disney and volatility because, like Warren Buffett, I'm old. I've been through a few cycles. I can take big roller coaster rides. Others I've discovered can't. So for them, more suitable are the ones where it's a bit easier on the eyes for them. So that might be your stop, or it might be here. There's the projection. It's a 7. It doesn't quite fit as a special situation because this isn't. It's not oversold. Let me explain what that means. Anything in the top quarter is overbought. Anything in the bottom quarter is oversold. You ideally want it somewhere down here. It's a bit too high. So it worries me momentum might not follow through, but UBS think it will. Morgan Stanley think it will. Wells Fargo think it will. Well, that's good news for them. Okay, I don't care what banks think. So not quite for me, but if somebody bought this and said to me, I got it, I looked at your thing, I know it's a 7, I know you gave me some, tell me what the risk was, I'd say that's fine. I don't have a problem with that. It's not a red flag for me. Okay, it's fine. It's just that just because I don't have it doesn't mean you shouldn't. And just because I have it certainly doesn't mean you should. You should be able to make up your independent mind based on the data that I'm giving you. But if there's ever any which aren't good enough, I'll tell you straight away. This is good. No issues with it. Okay, now let me give you some more. Trump trades some of the biggest S&P 500 rises since his electoral victory. So here we're just going through the S&P 500 biggest rises since his victory. Now, I'm not going to read all of this, but it's the same thing I've already said. 40% potential, 789, MACD, etc., etc. Okay, so whoops, Tesla again. Now you can see where I've put the stop loss. So on these charts, you can take pictures if you wish. Okay, and that looks good on the momentum. There's your stop. There's your multiple upside to downside, and so on. These are, why am I calling them Trump trades? They're the ones that moved the most since Trump came to power. McKesson, and I've marked in blue the stop. There's the direction. That's a bit overbought for me. Citigroup gave it a buy a couple of weeks ago. Okay, healthcare internationally, discount cash flow 57% undervalued. United Continental 9, bit overbought for my liking. Goldman Sachs said buy on the 15th. Okay, so with my Great Investments program, I go into more detail on these. It's because of some of the, I haven't gone through all of them. I've just shown you a couple of examples of what Trump trades are and the projections and why we're looking at such a high benchmark of returns. Because if we can't get that, then why would we look at it? If I want piss poor returns, I'll give my money to St. James's Place and pay for their kids to go to private school. Okay. What is very clear to me, and I think will be from everything that I've said so far, is this gap between US, that's the S&P, that's the Nasdaq, 600% on the Nasdaq, 300% on the S&P since 2009. That's just the index, and just 47 on the UK markets. That gap's going to get wider. That is certainly one guarantee I can give you. That gap over the next 3 years, 5 years, 10 years is going to get wider. I would say over the next 1 year, 2 year, 3 year, 4 year, 5, it's just going to get wider and wider, right? If you disagree with me, I'd like to know why from everything that I've said. That means these shitty little funds, Fidelity, St. James's Place, if they're in your pension and find out, call HR first thing in the morning, I'm worried because against the benchmarks they're setting themselves, their piss poor performance is shocking. So your pension's getting screwed by government tax and by fund managers underperforming. And now the government said they're going to force you to put even more money through those pension funds into British companies. So they're going to, basically you're shafted, okay, if that's what you're looking at and you're giving it to any of these. Guess who's lobbying the government to ask for more money from pensions to be given to them? Each of these companies, every single one of these lobbying the government. Oh, there's nobody saying what I'm saying other than I've written to Her Majesty's Treasury and the Chancellor to explain, listen, if they're British people and they own foreign stocks, that's actually rather good for Britain. It's good for balance of payments. It means they're landlords to American tenants who then bring the money to the UK and spend the money over here. It's good. Let them earn more, have a comfortable retirement. I don't think the government's that interested in people building assets because they've said very clearly, if you build assets, you're not a working person. If you're not a working person, this is not your government. Now, time to double money. Why do I care about the returns? Well, if I get what I get in my bank account, it's going to take bloody 17 years to double my money. If I do it in if I get 20%, I do it in 3.8 years. That's closer to the S&P and the Nasdaq. It's certainly closer to the Nasdaq. Okay. I'd rather try and double my money in 3.8 years than I would in 14.2 for obvious reasons. I'm going to guarantee something. I think the average return, I think the S&P or my pension is going to be up at least by 32%, by a third over the next 2 years. And you might say, you're cheating, Alpesh. I can see why you're cheating. You're cheating because you happen to know that's the average positive return on the S&P index over the next 2 years. And wait a minute, my friend, if you've got a bunch of 3 times leverage ETFs on the S&P and you hold them for the next 2 years and you get not 33 times 3, which is 100, but you double your pension in 2 years. Let's say you only get 50% right. You can beat the index. Yeah, I know. It's a cheating easy way. Nobody likes to do it the easy way. They all like to work hard for their living. It's just human nature. Nobody likes to sort of take shortcuts. But if I wanted to take a shortcut, which I am doing, which is having a bunch of the 3 times leverage ETFs, not recommended leverage for other people, well, there you go. That's what I expect. And that's just meeting the index. So even if I mess it up and I decide, do you know what, I'm going to pick a few individual stocks. Alpesh, you idiot, you should have just got the index tracker. I'll still do well. Parish's email is parish@tradermind.com. Okay, parish@tradermind.com. There we go. Now, that's why people, and this is why I do these online ones. I've got some more stocks coming. In 12 months, I've seen 30% increase in my portfolio. That's not, this is amazing for me and my family. I cannot thank Alpesh enough. I wish I invented the stocks that he invested in. I didn't create those companies. I'm not that clever. Okay, I wish I did. I don't have those resources. All I did is the same thing I've done from the age of 12, is work out that I would rather ride the coattails of really clever people and make money off their labor than try and build those companies. I didn't think that was rocket science, but apparently it is. Okay, and I knew those companies were more likely to be in America because I had a bigger choice to select from. So if I narrowed it down like CVs, narrowed it down from a big pool, surely I'm going to get better ones. I don't think either of those two statements put me in the genius category. They clearly don't. Yet, sometimes it's two simple, obvious things, and all of a sudden, wow, I get the credit. Thank you, Trevor. I get the credit. But my friend, you're the one who had the gumption to watch the webinars, pull the trigger, do the thing. So I can't take the praise. Thank you very much. I'm most grateful. And I get dozens of these every week anyway. But thank you. I'm most grateful. But it's actually the people who are running the companies and you guys who take the time on an evening to watch this and learn and open yourself up to it. If you want to see the videos with some people who are on the program, have a look at alpeshpatel These are videos. So click on the videos. It's not just a picture which says 5-star review with random blokes off the internet. These are actual videos. So watch the videos, please. Okay. You know it's very simple to open a SIP ISA. This is not an advertisement. I'm not recommending the Barclays one. By the way, if I was recommending SIPs and ISAs, just check out the price points between Interactive Broker, Interactive Investor, Free Trade, HL, Hargreaves Lansdown, AJ Bell, and just do a cost comparison. Okay. And the best way to do it is to call them up or on their online chat and say, look, I want to buy whatever size of whatever you want to buy is. So do it specific to you, because they all have different charging mechanisms and you need an accountant and a degree in nuclear physics to work out how much something's going to bloody cost you with all their charges and everything. But Interactive Investor, Interactive Brokers, and those, just have a look at them for SIPs and ISA. They're very easy to open a pension online. Okay. And the reason it's become more and more urgent is because every single year, every single month, I keep seeing this is from 2022 and it's not changed. Has your pension lost a fifth of its value this year? We reveal the lottery of returns on work retirement plans. I didn't write that. The Daily Mail did. Now you can see why I do this. Okay. I say it on the BBC when I get the chance. I say it on newspaper in my newspaper columns and so on. Give workers power to ditch pension schemes. This is from the Financial Times. UK regulation calls for reform. So you can see why. Okay, there's a call to reform. The Guardian, if you're not right wing and you're extreme left wing, here you go. Pensions. Why do those retiring face massive losses despite FTSE highs? I wish the Guardian would do an investigation into that, because I can tell you exactly why. Okay, and that one was thanks to a lot of pensions holding bonds. I thought bonds were cheap, Alpesh. I thought bonds were safe, Alpesh. Oh, my God, have you been fed a lie? Don't take my word for it. That's the Guardian. Why do those massive losses despite FTSE highs? Because they held a load of bonds in those pensions. And the price of bonds went down because the yields went up. Why do the yields go up and the prices go down? Thank our then Chancellor and Prime Minister. Telegraph. Have British fund managers become a pointless expense for investors? I didn't write that. The Telegraph did. You got the Guardian on one end of the political spectrum. You got the Telegraph on the other. Okay. So between the communists and the fascists, listen, you're covered. Nobody likes fund managers, retail fund managers. They're rubbish. One of the economists that I lecture on at Oxford when I was a visiting fellow there was Eugene Famer. He went on to win the Nobel Prize in Economics for proving the maths behind all of this and why fund managers underperform. We're not talking hedge funds, we're talking retail funds. Okay, why they underperform. So take control yourself. I'm a LinkedIn top voice. Do follow me on LinkedIn as well. Look, this is what happens. The media builds them up. Nick Drabble, poor investment performance. UK fund manager blames lack of exposure to tech. No shit, Sherlock. How crap do you have to be to have lack of exposure to tech, you absolute muppet? And he gets to manage your money. He gets to manage your money and they build him up. They get away with it. Honestly, it pisses me off so much. There you go. Scottish Mortgage Investment. Oh, they're so clever because they can advertise loads. 50% loss on name recognition. That's their performance in 2022. Ask your IFA. How did you perform in 2022? Why did you not tell me to go into cash? Why did you keep telling me to go to these funds? What do you have to say about Eugene Famer's Nobel Prize winning prize, which shows that the funds you keep putting me on are shit? Why are you putting me into UK funds when they keep underperforming? Why are the US exposure so little in the companies which keep doing so well? Ask them those, and they'll keep coming back with these are the excuses they're going to give you. Well, you don't want the downside volatility. It's only a few stocks which are performing well. Okay, so you've got to be careful. Why don't you just put me into an index tracker? Well, because I won't earn the fees. That's what he's really saying. So I'll tell you what he's going to say, and I'll tell you what he's thinking. What he's going to say is, well, no, this fund manager is really well educated. He went to Eton and then Oxford, and therefore he'll do really well. That's what he'll say. What he's thinking is, Are you bloody kidding? I've got 2 kids in private school. If I don't put it into that fund manager and get my kickback, then what the heck? How am I going to pay those school fees? All right. I might actually do one of those sort of videos when I tell you. This is my column in the Financial Times in 1999, 9/11, 1999. Okay. I've been switching virtually all of my long-term holdings from UK into US stocks, Alpesh, Financial Times 1999. This is the Financial Times September, 25 years later to the day. UK pension funds allocation to British stocks hits historic low. Oh, nice to know 25 years later, after screwing up so many people's pensions, somebody actually bothered to do something. Still very slow. You're being screwed. I don't want to manage your money. It's not worth my time and effort, I'm afraid, to manage your money because you haven't got enough of it. All right? I want you to manage it. I want you to know that SIPs and ISAs were created so you could manage your own pensions. That's why they were created. I want you to know you can do it because anybody can learn to drive. They can learn to invest. And it gets worse. Go give it to Blue Whale. They'll lose you 27%. An IFA on Twitter at that time justified this. He said, well, we've got to look over a 10-year period. And I said to him, my point is, in no year should a pension have lost a quarter of its value. In no year. Well, you got to look over 10 years, really, don't you? That's their excuse. You know why? Because by then the school fees won't apply for their kids. They'll have got through. Now, we had a very good year in 2021. We had a good year in 2022. In 2022, we held cash. So if you want to know average performance, in 2022, it was 0%. Alpesh, you're rubbish. 0% in 2022. Yeah, the market was down 20% because we had to hold cash for the reasons I showed you earlier. Why did we do extraordinarily well in 2021? Well, I didn't do well. The program, the computer, the data did well. These companies did well, and our computer system said these companies. Would I have picked these on any narrative? No. On any news story? Never. Ugly shoes, Crocs. Why the flipping heck would I ever pick them? I don't have an opinion on stocks. The computer has opinions on stocks. We follow the computer. Okay. Will I get that ever again? Let's say I guarantee you never again. Because I'd rather guarantee you that than guarantee you anything else. Okay. How did we do last year? Well, we didn't do extraordinarily well. The bloody market did. If the market stops doing well, we'll never do well ever again. But I do think it helps that we look over 12 months and we say if it drops 25%, we'll exit. Look at those interviews and videos. Like I said, alpeshpatel.com. Is 40% realistic? Only in the years where you get a massive tailwind like 2021, 2023, and I will add 2024 to that as well. Okay, high Saltino, high alpha stocks. Okay. And this was 2023. We didn't do incredibly well and get 80%. Those companies did. We just happened to ride their coattails. And it wasn't on a narrative of Tesla because I don't think I would have picked any of these on narrative. Maybe possibly NVIDIA on narrative and AI story, but that would be speculating. It was because of the data, value, growth, income, cash flow, Sortino, rising momentum, MACD. Will that ever happen again? No, I don't think it will. Except it did this year for so many stocks. I haven't worked out the full results for this year, but it did for so many stocks this year. Will it happen next year? I don't know. Might not. Might never happen ever again. Do you see? I didn't know NVIDIA was going to go up that much. If I did, I would have picked one stock and said, right, everyone piss off home, go to bed. Sorry for swearing. There's just one. I didn't know. What we knew was it ticks our boxes. That's why we had more than one stock. Because if we knew how much it was going to go, we would have picked more than one, wouldn't we? Okay. But this is the croaky slide. If you want to take a picture of it, people wrongly think this is the most important thing if they get it. No, in combination with the other things. It's like you can't say to me, here's a Rubik's Cube, I've solved it, Alpesh. And I say, no, you've only solved one side. Yeah, well, it's all right. It's really important one side, isn't it? No. Okay, value, growth, income, croaky, Sortino, alpha, momentum. All of those boxes need to be ticked. One thing we found is if only one of them's ticked, then you're gambling. Because you're more likely to get falls without knowing why, and it'll be one of the reasons you didn't tick. 30% per annum is what Goldman Sachs found companies with in the top 25% by cash return on capital invested. So I tick that box. It's not guaranteed to give me 30%. There's no guarantees because look, there's years when the market falls, you don't get that. There's no guarantees. Okay. These are some of the comments from that's a $2 billion hedge fund. Bernard was in my book, Mind of a Trader. I've had some great endorsements from CEO of American Express share people, Merrill Lynch, BBC, Financial Times, Coutts. The reason I say that is because when you've written books on this and proven the method, then you've gone to the experts in the industry and got peer reviewed. That has to be the standard. And the books were written not based on my research, based on collecting the research from either Nobel Prize winners or multi-billion-dollar funds and their research. Because I don't have a Nobel Prize winning brain and I don't have a multi-billion-dollar research department. So why don't I just take all their stuff, like a Eugene Famer on the research or a Goldman Sachs? Okay, I know it sounds obvious. Alpesh, why don't you just copy what really good people are doing? Yeah, that's it. That's all I did. I didn't invent any of this other than put it all together in one package. I found this slide again. I'm going to put more of these AI picks up for 2023. 2024. This was 2023 because we were using ChatGPT for fun. We'd feed in the Excel and then for fun, okay, and see what comes up. Now, this is for fun. Let me say that again. A bit like my Dogecoin holding is for fun. I'm likely to lose all my money in all my crypto holdings, which are not significant by any means because it's for fun and I don't like gambling. Okay. But my son, I said, look, Dogecoin, press Doge, and it is peanuts how much I've put in. Okay. So don't get overexcited and go and buy Dogecoin. Me and my son did it for fun. It's like we might go to Disneyland and buy Mickey Mouse notes for fun. Okay, it's bonding between me and my 6-year-old. We bond over Dogecoin and cryptocurrency and the stock market. Anyway, so AI picks were done for a bit of fun, and some of them been good. So I'll do this for 2024 and see what works. Again, at the moment, it's for fun. I'm not going to say we're only using AI. That's what we're using, and that's not going to change. We fed that into AI and gave it a load more other data and said which one's based on all the assume you are a cross between Jim Simons and Warren Buffett and a Nobel Prize winning economist, and you've read all the literature on what moves stock prices, both from the banks. Now look at this data and tell me, having looked at this data, both historic and subsequently what happened to those companies, what's the correlation between the data factors and their subsequent price moves? Are there certain factors which have led to winners and certain factors which haven't? Now tell me which stocks I would want to have. So it was that kind of a really detailed prompt, and Business Insider did 2 articles on me on that, and Yahoo Finance did an interview with me as well. You can find those on the internet on the results. Again, it's work in progress. I'm not going to send that prototype out. It's like one of Elon Musk's rockets. I'm not going to put humans on until I'm comfortable. Okay, so let's not get carried away with all of that. That was 2021. 2022 was 0% because we had to hold cash in a falling market. So what's your average? Well, 0 plus 55 equals 27.5. Jeez, maths A-level prize, and he couldn't even get that. If you got $500,000, by the way, all of this should be a no-brainer. If it's not a no-brainer, don't do it. We had one person, he said, well, can I give you money to manage and then I'll share the profits with you? And I said, no, for a start, you don't have enough money where to make it my interest. Secondly, that's a regulated business and I don't want to be doing that outside of my hedge fund. So thank you very much. And thirdly, if it's not a no-brainer and you don't want to do it yourself, you don't want to learn to drive, I don't want to be your chauffeur, mate. It's basically the point to him. I'll be your driving instructor, so I'll teach you, and then you learn to drive, but I'm not going to be your chauffeur for the rest of your life. Thanks very much. Those are the 2 things people want. They want the database, because without the data, the knowledge is useless. And they want the knowledge, which is this one, okay, for life. And the one thing they don't want, because without the knowledge, the data is useless, and without the data, the knowledge is useless. Those are the 2 things they want. Everything else is icing on the cake. They want the database and they want the calls with me and the videos that I give them to educate, but also the one-to-one calls. The one thing they don't want is ongoing subscription fees, weekly charges, monthly, or any charges of any kind. So we did that. We gave them 1, 2, and removed any weekly, daily, monthly fees. What I want to do is, having spun this out of my hedge fund, I want to get venture capital investment into it and then IPO the whole thing. Hopefully, subject to legal requirements, give all the people on the program some free stock, because they'll be the best promoters of it anyway, and then make it more global. We already have people from New Zealand, Australia, Canada, obviously the UK, substantial amount, America, obviously, India, UAE, Qatar, Anyway, I continue taking people on if they want the data and they want all of this. If you want a tour of all of this first, there it is. Go there and you can get Paresh to give you a tour. He's co-founder of a massive hedge fund where he developed all the strategies. The strategies actually he then put into a book. Very simple reason why. Very simple reason why he put every single one of those strategies from a hedge fund into that book. You can put it into a book and people they're not going to implement it. Just how people are. And they're certainly not going to put you out of business because that doesn't do it. Anyway, he's done that. That's separate to me. I mean, we co-authored that. I put my ones in, he's put his in, that's in there. If you go there, you'll be able to get some of the books to download. Not all of these, but you'll get some of them. And you can book a tour with him of everything that I've just shown you. If you don't want to have the tour and you just want to get one of those 10 places, because by the time you get a tour, there might be no spaces, then that's where you go, alpeshpatel.com/shares. I'm going to answer some questions now. Links is where you want to go. Also have a look at my campaign for 1 million to teach 1 million people how to be better investors and add 1 million into their portfolios over their lifetimes. What I also want to do is now answer some of the questions as well. Okay, so I'm going to do that now. Okay, I want to answer some of those questions now. Here we go. Thanks very much. SJB said Volta is no good. Polaris funds, not the missile summary. I know. I did leave them. Thanks, Alpesh. I know, Andy. Their funds fundamentally, their hands are tied behind their backs. It's not that they're out and out trying to defraud you. It's the fact that they have so much capital that they'll put it into a UK fund, which is limited in looking at things and so on. Whereas you can just do it yourself. Can I take my workplace pension and put it into a SIP? You would usually, yes, but before you do that, look, if it's a defined benefit, don't, because defined benefit is actually really good, and don't mess with that. As a general rule, do not mess with defined benefit. If it's defined, you can in principle, but you only want to do that if you've got the confidence of being able to do it and so on. I'm going to go through backwards some of the slides while I answer these questions. I put money in S&P in normal trading to 1 account and it's gone up. What's the best way to minimize tax when selling? Well, if you put it in SIP or ISA, then those are tax-free vehicles. They're sort of tax havens for people, normal people, if you see what I mean. Okay, because they've removed the CGT allowance so much. Thanks. Whoops. There's more questions. Alpesh, didn't intend to irritate you. Oh, sorry, John. My only point was that the stocks continue to low volatility, very low. But I can't remember. Did I sound irritated? Apologies. If it ain't broke, why fix it? Was also my portfolio similar? What may look to change and why? It's a very good question, actually, John. Generally, let's say you've got something like an Nvidia, like we've had for over 12 months, the thing you would want to do is say, if it drops X%, I'll sell Y, based on your risk appetite. And that can be a really good way of holding something almost forever, because if it drops, say, 10%, you might say, well, I don't want to sell any. If it drops 90%, I know before that I want to sell. So what's the number? So for 10, 20, 30, 40, you can put a number next to it, how much you'd sell if it drops that much. And best do that in times before it happens, because whilst it's happening, you'll be emotional. Okay. How do I work out Sortino and Alpha? Best place to get the data? Well, other than from me, it's not, please be warned, it's not just Sortino and Alpha what you want. I think Yahoo Finance might have data like that, if you look at it, but please be warned. And this is the mistake sometimes people think, oh, I only need those 2 things, that'll do. No, it's like the Rubik's Cube. If you don't have all of the things, you're just going to have thought, oh, I'm crossing the road, I'm looking both ways, and you get hit from something above. Or it's like looking at the road, when I cross the road, I'm only going to look to the left. Okay, that's what it's like, and that's the problem. Can you tell me if an option contract already includes 100 shares premium? It depends on which market you're looking at. Marguerite, maybe email me. I'm not entirely sure what you mean. But if what you mean is, if you're buying a call option and they're sized up, effectively, it gives you the right to buy. Sorry, it gives you the right to buy, but not the obligation, 100 underlying stocks, and that's the price you're paying. The premium is what you're paying, then yes, you're paying a premium to buy 100. But most people don't buy those underlying. They don't call the option. What they do is they sell it beforehand. That's why options are actually contracts for differences, because you're receiving the difference between the buy and the sell price. Can you? How do I work out? Now I'm going to go through some other stocks, and I just need to see if any of these trigger any things. Let me know. Or repost your question as well if I've missed anything. Otherwise, I will call it a night. Why is Tesla so high? The funny, and it's a really good question, Jeff. I'll tell you what we would have said on Bloomberg TV. Ex post facto, my colleagues would have said, well, of course, there's a lot of expectation of growth, blah, 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 and their next rocket, blah, blah, blah. And what I would have told them is momentum seems to be a significant factor because the valuation is clearly very high and there's growth and there's strong momentum. Other people are buying into it. Okay, so, and I've written about this in my book. Actually, I'll make sure you can access the book if you're online. Investing Unplugged, share. There you go. It should have popped up if you're on the webinar, not if you're on TikTok. It should have popped up already. Don't forget to like and follow if you're on TikTok. Now, the options contract, Marguerite, don't do options contract unless you fully understand it. You're saying it's priced at €4 premium. Yes, that sounds like it might be a deep out of the money option, which tend to have higher volatility, what's known as high vega, therefore a more significant risk of loss of 100% losing your money. So Marguerite, please be careful with options. Please don't forget, my question. Ross, yeah, please don't forget my question, Alpesh. 60% in 4 months, how to evaluate should it remain in the portfolio? Ross, I think you emailed me. Somebody emailed me like this. So what I would say, the best thing to do when you've had a bit of a windfall, because you might say, wait a minute, I've had a windfall. Why should I wait 12 months or for it to drop 25% and I might lose some? If it drops X, sell Y. You can determine X, it's easy, 10%, 20%, 30% from its existing level. And then Y, how much you'd sell, is based on your risk appetite. And I'll tell you why. Only in hindsight will you and I both know what the exact numbers to solve that formula to maximize your return is. We don't have hindsight. We don't have a time machine. So that tends to be the better way of doing it. The way in which I tend to decide is I look at the historic volatility of the stock, and I know with an NVIDIA, if it drops 33%, I probably still want to just hold on to it. Whereas I know with some other companies, if it drops even 10%, hey, that shouldn't happen. Do I put a stop loss at the initial purchase? No, I never put it in with the brokers because they tend to take it out at 3 in the morning and then blame their IT systems. But actually, it's just fraud. So will you fully remake your portfolio in 20? No, Akram, what will happen is, I'll give you a great example. It's a fantastic question. NVIDIA's in the portfolio, okay? Will I just get rid of it? No, why would I get rid of it given that it's not dropped X% and it's still going more and more? So why would I get rid of it? So what I call the quality 5 plus, Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA, Eli Lilly. I don't have Eli Lilly at the moment, just so you know, but in future I probably will. And Novo Nordisk. Okay, I'll hold those beyond 12 months if the exit rule I'll use is if it drops X, sell Y. That's the bottom line. Dominic, your question was, I'm looking for it. Okay, what time periods do you have filters like alpha and beta for 5 years? No, past 12 months. Okay, because accounts come out every quarter. The world moves too quick to be looking at 12 months. Are they trailing stops? You've got two types of stops you can use. You can use trailing. If you're going to use trailing, look at the most recent uptrend drawdowns and make it trailing based upon that. If the biggest drawdown is 35%, then make it trailing on that. If it's fixed, 25%. Tends to be fixed, subject to an NVIDIA type where you'd probably want to make it more bespoke than just fixed. Okay, for thin, at what price did you buy? I showed you the chart on Tesla. Jennifer's a newbie, Dan's new, Charlie's new. Fantastic, great to have so many new people. I'm going to put the questions back on. If there's anything I've missed, please let me know. Dominic, hopefully I've answered it. Have I missed any questions? If I have, is it worth buying? Is it worth drip buying the SB? Oh, brilliant! You've reminded me of something. One of the safer ways of, let me see if I've got it up here. let me just pull something up. One of the safer ways, I'm going way beyond the hours. You're more than welcome to stay on. I think I've hit 8:30. Oh my God, 95 minutes. Jeez. Okay, so stop losses. You could do that. All right. That's the simple version. That's the more complicated one. Theirs are the pros and cons. And I teach my students this. Once they learn this, life's so much easier for them. This is if you've got tons of profits. This is the one I do for my students anyway and monitor it twice a week. That's risk mitigation. Don't worry about that. So, well, it's sort of in here if you really want to risk mitigate. And the answer is, where's it gone? And most people want to risk mitigate there. You can dollar cost average. Don't put the whole in front, put in a third, then a third after. But there's another one, add to winners. I thought I had it in there and I haven't. Winners. No, it's not in there. Oh, that's interesting. Okay, the other alternative is you can add to winners, which is what happens is, and this is from some of the big hedge fund managers and what they taught me, is what you do in adding to winners. Sorry, it's so late, guys. I hope you don't mind that I'm continuing with this. What you do with the winners is, let's say this month you're not so sure, you're a bit lacking confidence, and you buy into ones which seem to tick all the boxes. The next month, instead of dollar cost averaging, you put more money into the ones which are actually up. Now, that's something which I looked at mathematically. I looked at from what the hedge fund managers who I interviewed for my book, Mind of a Trader, taught me. And it's a sort of a trading approach applied to investing. And that I found psychologically people find more comfortable as well. So they start with a small initial position size, then they add to only the winning ones, not to losers. Okay, which is what you would do in dollar cost averaging. You'd add to winner or loser in this way. And that I found that people found that rather comforting and comfortable. Okay. Is there a preferred PE ratio or is there a metric for gauging value? So when I looked at the research which came out of this, it's again, a brilliant question. I should just do one of these where I just answer questions and be led by that sort of Socratic method, I think they call it. I might be wrong. I might be overreaching there. So I'm going to show you something on screen now. Give me 1 second. Here we go. Okay, so I'm going to show you this on screen. Make sure that I share your screen. Right, here we go. So on the education, what I did is I looked at, well, how do I know? So if you go to alpeshpatel.com/shares, you'll see a whole bunch of free information as well, which you'll find helpful and useful. So it's alpeshpatel.com/shares. Okay, and how 2023 turned out and all the rest of it. And there's a whole load of information there. So what we did is I looked there at what were the factors and the research behind it. So I'm very much research based and data based, and the research has to be top quality and backed up. And what we found is that absolute PE ratios were better than relative ones. We didn't find that out. That's what the research from one of the biggest banks oh no, it's not there. I can't find it now. But yeah, it's in the education. So sometimes my students will say, "Well, tell me, how did you get this? What did you find from the Nobel Prize? Well, where's the article on this? I want to read it. How did you get that conclusion?" So I show and share that. What I also show them, they don't have to look at all of this because obviously most people don't want it. They want the one-to-one with me and they want the data and then they want to get on with it. But what I also show them, which I think is really important. Sorry, let me go up here. Is if there's something good from Goldman Sachs, I will share that with them, and what the hedge funds and their ideas are, I will share that with them. But I'll also share. You might think, bloody hell, it's a lot of stuff. A lot of people give this to their kids. They say, well, actually, and you can access some of these without even signing in. So there you go. There's a reason why I provocatively put suitable for women, because the answer is hell yes. But the idea was to get them to do it because women are far less likely to manage their own finances and therefore are more dependent, more financially being left behind. So it's even more important that proactively women are encouraged to look at this. That's what the data shows. And in America, they're far ahead of us on that. And arguably have more financially independent women. And there's all sorts of benefits to the economy and for the people themselves when they're financially independent. and not beholden. Wealth outlooks. So when we get these, like UBS Wealth Management Outlook, I'll put all of those on. But there's a new thing we started doing. I've got a podcast which takes these and has a conversation in simple language about those. So I've just done one for Goldman Sachs, and actually I've got to put that on. I'll put that on my on alpeshpatel.com/links, the link to the podcast tonight. I'll make sure I do it tonight because I don't think I've done that yet. So I'll make sure I do that for you. I think I better call it a night now, actually, I guess, on this. Let me just check any more questions. Thank you for everybody who signed up. I will send you an email shortly. You've given me, some of you sent me private message to say you've signed up. Feel free, I'll give you a shout out if you want me to. But yes, thank you all who've come on. Is there a presentation? No, the presentation is on the video. I'll make it available on YouTube later tonight, probably. Would you only do 12 months of stuff like correlation volatility? Yes, exactly, Dominic. Robin Brill, thanks. Thank you all. I'll make sure I put it up on YouTube. For TikTok, it has to be snipped probably into 2 parts because TikTok can only do 60 minutes. So I'll work a way of doing that, although I think I can rebroadcast the live, which might be a way in because I've done the live, but I'm not sure how clear the live is to see. There's what happens if I do it like this. Should have probably done this the whole way through. Sorry. That's a lot easier on TikTok. Thank you all. Thanks, everyone. I hope that all made perfect sense. Sorry I've gone on for so long. As you can tell, I absolutely love this stuff. I'll share a few more things with you for the people who are on here. And yeah, I will put on the books and the podcast stuff. The podcast is really good because I listen to it over and over again, because I'll give you an example. If there's 15 new documents from UBS Goldman Sachs for 2025 Outlook, and they're all 50 pages long, instead of reading it on the podcast, we condense that into a 20-minute podcast and in simple language and just focused on equities. So it makes my life so much easier to then say, okay, now I know. And I do that when I go for a morning walk or whatever. So I'm really well briefed on what every single one of the major banks does. And then when I do my stock market update, that's on there as well. Okay. So that's the Tesla one. So that's that. But yeah. Okay, everyone, I'm going to go now. Like I said, thank you all. Have a good night, everyone. And thanks everyone who's been on TikTok as well for this. Thoughts on Disney? Well, it's at, I think, 12-month highs. So I did Disney earlier. It's the podcast is on Spotify. If you put my name on Spotify, you'll see there's a couple there. So it's on there. Sorry, I'm just talking to the ones on TikTok. I might continue doing that. I'll take this over to TikTok now. Thanks everyone who's been on the webinar. Really appreciate it. I will speak to you